Ladies and gentlemen, listen carefully because what is happening in silver right now may be telling you something far more important than most investors realize. I am not talking about a routine move in a commodity market. I am not talking about temporary enthusiasm or another short-term trading opportunity. I am talking about a signal that could be pointing toward growing stress inside the financial system itself. Most people see silver moving higher and immediately focus on the price. They focus on profits, they focus on momentum, they focus on whether the rally can continue next week or next month. But serious investors understand that price alone is never the full story. The real question is what behavior is driving the move. The real question is why capital is suddenly seeking exposure to hard assets at this particular stage of the cycle. You need to understand what is happening beneath the surface, because the surface is often misleading. Markets have a way of appearing healthy right before instability becomes visible. They have a way of projecting confidence while pressure quietly accumulates underneath. That is why history repeatedly catches the majority by surprise. Most people react to outcomes. Very few study the conditions that create those outcomes. And when I step back and look at the broader environment today, I do not see a system becoming stronger. I see a system becoming more dependent on confidence. I see debt burdens that continue expanding. I see governments struggling to manage obligations that grow larger every year. I see central banks attempting to balance inflation's concerns against financial fragility. I see credit conditions tightening while economic expectations remain overly optimistic. That combination deserves attention because financial systems do not break when everyone expects them to break. They become vulnerable when confidence remains high despite deteriorating fundamentals. They become fragile when investors stop asking difficult questions. They become dangerous when leverage is treated as normal and liquidity is assumed to be permanent. This is why I believe silver holders need to pay close attention right now. The rally itself is not the most important story. The message behind the rally may be for years markets operated under a simple assumption. Whenever serious problems emerged, policymakers would intervene, liquidity would return, interest rates would fall, risk assets would recover. Investors became conditioned to believe that every disruption was temporary and every crisis would eventually be solved through some form of monetary support. That mindset became deeply embedded throughout the system. But every cycle creates consequences. Every rescue creates dependency. Every expansion of liquidity encourages additional borrowing. Every period of easy money pushes participants toward greater risk. Over time, the system becomes increasingly reliant on conditions remaining favorable. The problem is that favorable conditions never last forever. At some point, debt levels become so large that maintaining stability becomes more difficult. At some point, inflation pressures limit policy flexibility. At some point, confidence begins carrying more weight than the underlying fundamentals can support. That is when markets enter a very different phase. I want you to think about the role liquidity plays in modern finance. Liquidity is not simply cash. Liquidity is the ability to borrow, refinance, transact, and reposition without disruption. It is the lubricant that allows the entire financial machine to function smoothly. When liquidity is abundant, risk appears manageable, asset prices rise, credit expands, investors become comfortable. But when liquidity begins tightening, everything changes. Borrowing becomes more expensive. Refinancing becomes more difficult. Credit becomes more selective. Investors become cautious. Suddenly, decisions are no longer driven by opportunity. They are driven by necessity. This transition is where many major financial problems begin. The public rarely notices it immediately because liquidity deterioration is often gradual. At first, there is no single headline announcing that conditions have changed. Instead, there are small signals. Funding costs move higher. Credit markets become less flexible. Certain assets begin behaving differently. Defensive positioning starts increasing. Capital begins searching for protection. That is why silver matters. Silver occupies a unique position inside the financial world. It is partly an industrial asset. It is partly a monetary asset that sits between economic expectation and monetary concerns. Because of that, silver can sometimes reflect shifts in investor psychology before those shifts become obvious elsewhere. I am not saying every silver rally predicts a crisis. What I am saying is that context matters. A silver rally during a period of strong growth, healthy balance sheets, stable debt levels, and abundant liquidity sends one message. A silver rally during a period characterized by elevated debt, tightening financial conditions, policy uncertainty, and growing concerns about monetary credibility may send a very different message entirely, and that distinction is critical. Most investors are trained to think in terms of isolated markets. They analyze stocks separately from bonds, bonds separately from commodities, commodities separately from currencies. But the reality is that all of these markets are connected through liquidity. Everything depends on liquidity. When liquidity expands, capital flows freely across the system. When liquidity contracts, stress begins spreading through those same connections. What starts in one area eventually influences another. Credit affects equities. Equities affect confidence. Confidence affects spending. Spending affects growth. Growth affects debt sustainability. The system is interconnected. That is why experienced investors spend so much time studying structural conditions rather than individual headlines. They understand that major transitions usually begin long before the public recognizes them. They understand that market behavior often changes before the narrative changes. And right now, I believe there are reasons to pay attention because the real question is not whether silver can continue rising. The real question is whether this rally is reflecting something deeper, whether it is signaling growing concern about liquidity, whether it is signaling declining confidence in the durability of current financial conditions, whether it is signaling that capital is beginning to reposition ahead of a larger adjustment that most people still cannot see. Those are the questions serious investors should be asking. Because if liquidity pressures are beginning to build beneath the surface, then what appears to be strength today could ultimately become one of the earliest warnings of a much larger financial transition that is only beginning to unfold. Now, I want you to take this analysis one step further because understanding liquidity is only the beginning. The larger issue is what happens when liquidity stress collides with a financial system already carrying extraordinary levels of leverage. Most investors underestimate leverage because they only see its benefits during expansion phases. They see rising asset prices, they see strong returns, they see growing portfolios. What they do not see is the vulnerability being created underneath. Leverage magnifies gains when conditions are favorable, but it also magnifies instability when conditions begin to deteriorate. That is why debt cycles always appear strongest near the end. Think about what has happened over the past several decades. Governments borrowed more, corporations borrowed more, consumers borrowed more, financial institutions expanded balance sheets. Markets became increasingly dependent on cheap financing and abundant liquidity. As long as interest rates remained low and confidence remained high, the system appeared stable, but stability built on leverage is often deceptive. The appearance of strength can persist for years while underlying risks continue accumulating. Investors become comfortable, policymakers become confident. Market participants begin assuming that because something has worked for a long time, it will continue working indefinitely. History repeatedly proves otherwise. Every major debt cycle follows a familiar pattern. Expansion creates optimism. Optimism encourages borrowing. Borrowing fuels growth and asset appreciation. Rising asset values justify additional borrowing. The cycle reinforces itself until leverage reaches levels that make the entire system increasingly sensitive to disruption. Then eventually something changes. Sometimes the trigger seems insignificant at first. It might be weakening credit quality, it might be refinancing pressure, it might be slowing economic growth, it might be a loss of confidence in policy decisions. The trigger itself is often less important than the vulnerability already present within the system. When leverage becomes excessive, Even relatively small disruptions can create disproportionately large consequences. This is where liquidity crises begin. Liquidity crisis is not necessarily about insolvency. It is often about access. It is about the ability to obtain funding when funding suddenly becomes scarce. It is about the ability to meet obligations when conditions become less forgiving. It is about maintaining flexibility when flexibility becomes increasingly expensive. Most people fail to appreciate how rapidly this dynamic can develop. During stable periods, investors assume liquidity will always be available. They assume markets will remain functional. They assume refinancing opportunities will continue. They assume buyers will always exist when they need to sell. Those assumptions work until they do not. Once confidence begins weakening, behavior changes remarkably fast. Investors become defensive, lenders become cautious, risk tolerance decline, market participants begin prioritizing preservation rather than expansion. The focus shifts from maximizing returns to protecting capital. That shift can have enormous consequences because when a system is heavily leveraged, small changes in behavior can produce large changes in outcomes. This is exactly why margin pressure becomes such a serious concern. Most people hear the term margin call and imagine a problem affecting only a small group of aggressive traders. In reality, margin pressure can influence the entire financial structure. It represents a process where declining confidence forces participants to obtain liquidity regardless of their long-term views. That distinction matters. When investors sell because they choose to, markets remain orderly. When investors sell because they must, markets behave very differently. Forced selling creates additional pressure. Additional pressure weakens collateral values. Lower collateral values trigger additional demands for liquidity. That process can become self-reinforcing. This is how instability spreads. The mechanism remains remarkably consistent throughout financial history. Even though the specific assets involved may change, the details vary. The structure does not. That is why I continue emphasizing preparation rather than prediction. You do not need to know the exact catalyst in advance. You do not need to identify the precise moment conditions shift. What matters is recognizing the environment in which vulnerabilities are increasing. And when I evaluate today's environment, I see multiple areas where fragility appears to be growing simultaneously. Global debt remains extraordinarily high. Governments continue facing mounting fiscal obligations. Interest expenses are consuming larger portions of public budgets. Corporate refinancing challenges are emerging. Consumers are facing higher costs across numerous categories. Credit conditions are becoming less accommodating. None of these developments exist independently. Together they create pressure. Pressure that can remain hidden for extended periods before suddenly becoming visible. This is why I believe many investors are underestimating the significance of current market behavior. They remain focused on isolated events rather than systemic relationships. They look at individual asset classes without considering the broader structure connecting them. But financial systems function as networks. Stress does not remain isolated forever. It moves through the system. It migrates from one area to another. It influences behavior across markets. That is where silver becomes especially interesting. If investors are becoming concerned about future liquidity conditions, if they are becoming concerned about monetary credibility, if they are becoming concerned about the sustainability of existing debt burdens, then hard assets can begin attracting attention before those concerns become obvious in public discussions. Markets frequently communicate through positioning before they communicate through headlines. That is an important lesson. The crowd usually waits for confirmation. Serious capital often acts before confirmation arrives. This does not mean institutional investors possess perfect foresight. They do not. What they often possess is a greater appreciation for risk. They understand that financial transitions rarely announce themselves clearly. They understand that opportunities and dangers frequently emerge while public attention remains focused elsewhere. That perspective becomes increasingly valuable late in debt cycles because later-stage debt cycles create illusions. They create the illusion that rising prices represent genuine strength. They create the illusion that stability is permanent. They create the illusion that policy tools remain unlimited. They create the illusion that risk has been permanently reduced, but debt does not disappear simply because confidence remains elevated. Obligations continue accumulating. Vulnerabilities continue growing. Fragility continues building. Eventually, reality begins reasserting itself. And when that process begins, investors often discover that conditions are far less stable than they previously believed. This is why I want you to think carefully about what silver's rally may be communicating, not because it guarantees a crisis, not because collapse is inevitable tomorrow, but because market signals deserve attention when they emerge alongside broader structural concerns. Right now, we are operating in an environment characterized by substantial debt burdens, elevated uncertainty, constrained policy flexibility, and increasing questions about long-term financial sustainability. Those conditions matter. They create a backdrop in which liquidity becomes increasingly important. And when liquidity becomes important, investor behavior begins changing. Capital seeks resilience. Capital seeks optionality. Capital seeks protection. The majority usually notices these shifts only after they become obvious. The minority notices them while they are still developing. That difference can determine who is prepared for major transitions and who is forced to react after the fact. Because once liquidity concerns become visible to everyone, opportunities often look very different than they did during the early stages. The advantage belongs to those who recognize the signals before the crowd accepted the message. And if silver is indeed acting as an early indicator of growing liquidity concerns, then understanding that possibility today may prove far more important than most investors currently realize. And this is where the conversation becomes even more important because liquidity stress rarely remains confined to a single market. Once confidence begins weakening inside a highly interconnected financial system, the effects can spread far beyond their original source. Most people assume financial disruptions develop in a straight line. They imagine a specific problem emerges. Everyone recognizes the danger, policymakers respond, and stability returns. Real-world financial systems rarely operate that way. The process is usually far more complex. Pressure builds quietly beneath the surface. Certain sectors begin showing weakness, funding becomes slightly more expensive, credit standards become slightly tighter, risk appetite begins fading around the edges. At first, these changes seem insignificant. Then they start connecting. That is when conditions can shift much faster than most investors expect. The reason is simple. Modern financial systems are built on confidence. Confidence allows governments to issue debt at favorable rates. Confidence allows corporations to refinance obligations. Confidence allows banks to extend credit. Confidence allows investors to accept risk in pursuit of return. Confidence supports the entire structure. And confidence is not a permanent asset.